Why do most traders fail in intraday algorithmic trading? There are many reasons why most traders fail in intraday algorithmic trading, and these reasons often stem from a lack of understanding and preparation. A common misconception among traders is that using algorithms means they no longer need to understand the market in depth. They assume that automation will take care of everything, from decision-making to execution. However, this is far from the truth. Understanding market dynamics, such as liquidity, volatility, and trends, remains crucial. For example, a trader who didn't consider the liquidity of certain assets when building his algorithm. His strategy worked well during periods of high liquidity but fell apart during low liquidity times when slippage became a significant issue, causing major losses that his system was not equipped to handle. A common reason for failure in algorithmic trading is the over-optimization of strategies on past data, often referred to as curve fitting. Traders can spend months perfecting a strategy that performs exceptionally well on historical data, only to see it fail in real-time trading. This happens because the algorithm has been designed to exploit patterns that may no longer exist in the current market. For instance, a trader I worked with developed a strategy that worked flawlessly over 5 years of back-tested data, producing consistent profits. However, when he deployed it in live markets, the algorithm struggled and quickly began to lose money. Why? The strategy was too tailored to historical trends that were no longer relevant, and it couldn't adapt to real-time changes in the market. Another significant factor is the neglect of risk management. Automated systems can execute trades at an incredible pace, opening the door for massive risks if not controlled properly. A single trade going wrong, or a sequence of small losses, can snowball into a large financial disaster. For example, one trader set up an algorithm without proper stop-loss mechanisms, assuming the algorithm would correct itself during the drawdown period. Unfortunately, when the market experienced a sudden crash, his system kept executing trades, piling up losses that could have been mitigated with the right risk management in place. Risk controls like stop losses, position sizing rules, and even fail-safes for market anomalies are essential but often overlooked by traders eager to get their algorithms running. Over-reliance on technology is another common issue. Algorithms are not infallible. They rely on the data and parameters you give them and can't always adjust to real-time, unforeseen events. Many traders assume that once their system is set up, it can run without much oversight. However, I've seen cases where this overconfidence in technology has led to failure. For example, a trader whose algorithm was running during a major market event. A technical glitch caused his system to miss crucial trades, and because he wasn't monitoring it closely, the system continued running under faulty conditions, resulting in severe financial losses. This situation could have been avoided if there had been manual oversight or a backup plan in case of technological failure. A related problem is the failure to adapt to changing market conditions. Markets are in a constant state of flux, driven by a variety of factors, economic, political, and even environmental. An algorithm that worked well last month may no longer be effective today. For example, one trader developed a highly successful strategy that made consistent profits for over a year. However, when new economic data came out, and the market conditions changed, his algorithm started underperforming. Instead of adapting the algorithm to the new market environment, the trader kept running the same version, assuming it would eventually recover. Unfortunately, it didn't, and he ended up losing the majority of his gains. Another issue that catches many traders off guard is inadequate capital. Algorithmic trading, especially on an intraday basis, often requires substantial capital to cover positions during periods of drawdowns or to handle transaction costs like slippage and commissions. At seminars and conferences, I often hear about traders with great strategies who went bankrupt simply because they didn't have enough capital to sustain their businesses. For example, a trader had a high-frequency trading strategy that worked well in backtesting, but in live trading, he didn't account for the significant transaction costs. His initial capital wasn't sufficient to cover these ongoing costs, and after a series of small losses and fees, he had to shut down his trading operations entirely. Even though algorithmic trading is supposed to remove emotional bias, Many traders still find themselves intervening in their systems when emotions like fear and greed take over. This often leads to bad decisions. I recall one trader who was running an algorithm designed to take advantage of short-term volatility. During a market downturn, his algorithm started losing money, and instead of letting it run its course, he manually stopped it out of fear. Had he stuck to the plan, the market would have eventually turned, and the algorithm would have recouped the losses. By intervening, he not only interrupted the system's natural process but also missed out on potential profits. Lack of proper testing in live conditions is another frequent mistake. Backtesting is a valuable tool, but it's not enough to prepare an algorithm for real-world conditions. Many traders jump straight from backtesting to live trading without conducting sufficient paper trading or demo testing in live market conditions. One trader I worked with had backtested his algorithm extensively and saw consistent profits. However, when he deployed the algorithm in a live market, he hadn't accounted for factors like slippage, latency, and real-time order execution issues. The strategy that worked so well in theory didn't hold up in practice, and his profits quickly turned into losses. Ignoring transaction costs is another factor that can derail an otherwise solid strategy. High-frequency trading algorithms, in particular, are vulnerable to having their profits eaten up by commissions, spreads, and slippage. I've seen traders develop highly promising strategies that look great on paper, but once you factor in the transaction costs, their profit margins shrink dramatically, sometimes to the point where the strategy is no longer viable. For example, I work with a trader who was trading very frequently, executing hundreds of small trades a day. He was making profits on paper, but after including transaction costs, he realized that he was actually losing money in the long run. Finally, lack of diversification is a common pitfall. Many traders focus too narrowly on a single asset, market, or strategy, leaving themselves vulnerable to significant losses when that asset or market experiences volatility. I know a trader who focused all his resources on a single currency pair. When a geopolitical event caused extreme volatility in that currency, his algorithm couldn't handle the drawdowns, and he ended up losing a large portion of his trading capital. Diversifying across different asset classes, markets, and strategies helps spread risk and provides more stability over the long term. In conclusion, most traders fail in intraday algorithmic trading due to a variety of factors. Lack of market knowledge, over-optimization, poor risk management, and emotional interference are among the top reasons. The allure of algorithmic trading often blinds traders to the complexities and risks involved. To succeed, it's essential to maintain a deep understanding of the markets, rigorously test strategies under real-world conditions, stay adaptable to changing market conditions, and ensure sufficient risk controls are in place. By addressing these common pitfalls, traders can significantly improve their chances of success in this highly competitive and dynamic field. Thank you for watching.